Ladies and gentlemen, when the largest financial institutions in the world quietly change their behavior, you should never ask what they said, you should ask what they did. Because history teaches us a simple rule: banks speak optimism, but they act on fear. Today's discussion is not about rumor, hype, or market gossip. It is about power, incentives, and a sudden reversal that exposes far more than it explains. JP Morgan has gone long after years of positioning the other way, and that shift tells us something fundamental has broken beneath the surface of the global financial system. Here is the first hook you must sit with. Major banks do not reverse positions unless the cost of being wrong has become greater than the cost of being exposed. This is not courage. This is survival. And when survival instincts activate inside institutions of this size, it means the underlying structure of the market has already changed. For years, we were told that markets were stable, inflation was transitory, and commodity pressures were manageable. Yet behind the curtain, balance sheets told a different story. Debt levels expanded, leverage intensified, and risk was normalized under the assumption that central banks would always intervene. But systems built on permanent rescue eventually encounter a moment when rescue becomes inflationary, politically unacceptable, or simply ineffective. When that moment approaches, capital moves first, and explanations come later. JP Morgan's reversal is not about confidence and growth. It is about hedging against disorder. Going long in this context is not a bullish celebration, it is a defensive maneuver. It reflects a recognition that paper promises, derivatives, and financial abstractions are increasingly disconnected from real economic constraints. When production slows, supply chains strain, and energy and material inputs tighten, financial engineering cannot manufacture stability. At that point, institutions reposition toward assets and exposures that benefit from volatility rather than smoothness. Here's the second hook. Insiders do not leak information to inform the public. Leaks happen when internal consensus cracks. Someone inside wanted this shift noticed. Why? Because silence no longer protects the institution, it endangers it. When internal risk models start flashing warnings that can no longer be ignored, banks rush to the same side of the trade, not because they agree, but because they fear being last. This brings us to the deeper issue: concentration of power. A handful of financial actors shape markets not through prediction, but through coordination. When one giant moves, others must respond or absorb the shock. This is not a free market in the romantic sense. It is a managed system where scale determines outcomes. And when the managers lose confidence in the system they oversee, volatility becomes policy by default. Notice also what is not being discussed publicly. There is little conversation about structural debt dependence, declining purchasing power, or the growing gap between financial markets and the lived economic reality of workers. Instead, narratives focus on technical adjustments, portfolio rebalancing, and strategic positioning. These are polite phrases that mask a far less comfortable truth. The system is increasingly unstable because it demands infinite growth from finite resources and stagnant wages when a systemically important financial institution reverses its market position. The shift should never be interpreted as a routine adjustment or a sudden change in outlook. These institutions operate with layers of risk committees, stress models, and regulatory oversight that make directional changes slow, conservative, and deeply calculated. A reversal, especially after a prolonged period of holding the opposite stance, signals that the underlying risk environment has altered in a way that existing assumptions can no longer explain. This is not confidence entering the market, it is caution reasserting control. Here is the first hook that matters: large banks do not chase upside, they avoid catastrophe. Their primary objective is not profit maximization in the short term, but preservation of capital across cycles. When downside scenarios begin to show nonlinear outcomes, where small disruptions trigger outsized losses, the rational response is to reposition early, even at the cost of public inconsistency. In these moments, appearing wrong is far less dangerous than remaining exposed. Institutional risk models are built to detect stress before it becomes visible in headline indicators. Rising correlations across asset classes, declining liquidity in derivatives markets, and increasing margin sensitivity all serve as early warning signals. A position reversal reflects the recognition that traditional hedges may no longer perform as expected under future conditions. This is the quiet admission that the probability distribution of outcomes has shifted, with tail risks becoming central risks. Another critical hook emerges here. Markets do not break suddenly, they fracture slowly, then all at once. By the time volatility appears obvious to the broader public, balance sheets have already been repositioned by those closest to the system's plumbing. Banks move first because they must. Their interconnectedness means that being late is not an inconvenience, it is an existential threat. This behavior also exposes a fundamental asymmetry in information and accountability. Public-facing commentary emphasizes stability and resilience, while internal strategies prioritize insulation from shocks. This duality is not deception, it is structural necessity. Financial institutions are obligated to reassure markets, even as they quietly prepare for outcomes that reassurance cannot prevent. The result is a widening gap between narrative and behavior is always the more honest signal. Perhaps the most revealing hook is this: reversals occur not when risk is highest, but when risk becomes unmanageable under existing frameworks. At that point, the institution is no longer expressing a view on price direction. It is responding to a loss of control over the system's dynamics. In economic terms, this marks a transition from equilibrium-based thinking to contingency planning, where survival dominates forecasting. In this context, a major bank going long should be read as a defensive maneuver embedded in fear, not optimism. It reflects the recognition that the cost of staying wrong has increased beyond tolerance. Such moments are rare, consequential, and often misunderstood, yet they consistently precede periods of structural adjustment in the financial system. In financial markets, explanations always arrive after positioning, never before. Capital does not wait for press releases, analyst upgrades, or carefully worded interviews. It moves when internal data changes, when risk thresholds are breached, and when the cost of an action begins to outweigh the cost of being early. This sequencing is not accidental. It is the operating logic of institutional finance. By the time a narrative reaches the public, the most consequential decisions have already been executed. Here is the first hook: markets speak in flows, not words. When large institutions adjust exposure, they are revealing information that cannot be expressed openly without destabilizing the very system they operate within. Public narratives are designed to smooth reactions, preserve confidence, and avoid feedback loops that could accelerate volatility. Capital movement, by contrast, is unfiltered truth. It reflects what institutions believe will happen, not what they want others to believe. This dynamic creates a structural lag between reality and perception. Asset prices often begin shifting, while official commentary insists that fundamentals remain sound. This is not because fundamentals are irrelevant, but because their interpretation has already changed internally. Risk is being repriced quietly, through balance, sheet adjustments, collateral demands, and hedging strategies that rarely make headlines. The visible story remains calm, even as the invisible architecture of the market is being rearranged. Another critical hook emerges here. Narratives are optimized for stability, capital is optimized for survival. Institutions cannot afford to be transparent in real time without triggering the very crisis they are attempting to avoid. As a result, explanations are retrofitted after positions are secured. What the public receives is not a window into decision-making, but a justification designed to align perception with outcomes already locked in. This sequencing also explains why sudden market moves often appear irrational to outside observers. Without access to flow data, internal stress tests, or counterparty risk assessments, the public is left interpreting price action through outdated assumptions. When volatility spikes, commentators scramble for causes, unaware that the causes were identified and acted upon weeks or months earlier. The shock is not the event itself, but the delayed recognition of it. Perhaps the most revealing hook is this: when narratives finally shift, they do so in a way that normalizes what was once unthinkable. Language evolves to make disruption sound orderly, inevitable, even prudent. What was previously dismissed as unlikely becomes framed as obvious in hindsight. This is how markets psychologically absorb change without confronting the deeper instability that produced it. Understanding this relationship between capital movement and narrative formation is essential for interpreting institutional behavior. Price is not a prediction. It is a footprint. It shows where power has already moved, where risk has already been acknowledged, and where the next explanation will eventually point, long after the decision has ceased to be optional. High leverage transforms financial systems from resilient networks into fragile constructions where minor disturbances can trigger disproportionate consequences. In such environments, stability is an illusion maintained only as long as conditions remain perfectly aligned. The moment interest rates shift, liquidity thins, or collateral values fluctuate, leverage stops amplifying returns and begins amplifying risk. This is the context in which institutional sensitivity to volatility dramatically increases, and it is within this context that major positioning changes occur. Here is the first hook: leverage does not fail gradually, it fails suddenly. When balance sheets are extended, there is little margin for error. A small increase in funding costs or a modest decline in asset prices can force rapid deleveraging, margin calls, and forced asset sales. Institutions understand this dynamic intimately, which is why they monitor leverage ratios not as static metrics, but as stress multipliers that accelerate instability once thresholds are crossed. As systems approach inflection points, correlations between assets rise. Instruments that were assumed to provide diversification begin to move together, undermining traditional risk management strategies. Hedging becomes less effective precisely when it is most needed. This convergence is a warning signal that leverage is no longer distributing risk, but concentrating it. When institutions anticipate this shift, they reposition in advance, not to seek advantage, but to avoid being trapped by their own exposure. Another critical hook lies in the feedback loops created by leveraged structures. Price declines force selling, selling pushes prices lower, and lower prices trigger further selling. This self-reinforcing cycle turns volatility into a systemic force rather than a temporary condition. Large institutions do not wait for these loops to fully engage. They move when the probability of such dynamics increases beyond acceptable limits. By the time stress is visible in market indices, internal alarms have often been sounding for months. Leverage sensitivity also extends beyond financial markets into the real economy. Highly leveraged systems depend on continuous growth, stable employment, and predictable consumption patterns. When economic momentum slows or input costs rise, debt servicing becomes more fragile. Financial institutions, aware of this linkage, interpret macroeconomic weakness not as an isolated slowdown, but as a potential catalyst for widespread balance sheet stress. Positioning adjustments reflect this broader recognition. Perhaps the most important hook is this: leverage changes the meaning of uncertainty. In low leverage environments, uncertainty can be tolerated, even exploited. In high leverage systems, uncertainty becomes toxic. The range of possible outcomes narrows, but the consequences of deviation grow extreme. When institutions sense that uncertainty is increasing faster than their ability to manage it, they act decisively. What appears externally as a strategic shift is, internally, an urgent response to a system nearing its tolerance limits. Insider leaks rarely occur in environments of confidence and cohesion. They emerge when internal agreement fractures and the official narrative no longer aligns with the private assessment of risk. In highly regulated financial institutions, information is tightly controlled and communication is deliberate. When details escape these boundaries, it is not accidental. It is symptomatic of rising internal tension and uncertainty that can no longer be fully contained. Here is the first hook: silence is a sign of stability. Leaks are a sign of stress. As long as decision makers share a common framework for interpreting market conditions, there is little incentive to allow information to surface prematurely. A leak indicates that competing interpretations have emerged, and at least one faction believes that withholding information is now more dangerous than revealing it indirectly. This reflects a breakdown in consensus rather than a desire for transparency. Internal risk assessments often evolve faster than public positioning. Models begin to diverge. Stress scenarios widen, and previously dismissed risks gain credibility. When these shifts are not acknowledged externally, frustration builds within the institution. Leaks become a pressure valve, allowing internal concerns to be signaled without formally contradicting official statements. This is not whistleblowing in the moral sense. It is strategic signaling under uncertainty. Another critical hook lies in the audience of the leak. Such information is not intended for the general public, but for other institutions, counterparties, and sophisticated market participants capable of interpreting its implications. Leaks function as coded messages, conveying that internal conditions have changed and that reliance on prior assumptions may no longer be safe. In this way, they subtly reshape expectations without triggering immediate market disruption. This phenomenon also reveals the limits of centralized control within complex organizations. As systems grow larger and more interconnected, maintaining narrative discipline becomes increasingly difficult. Different divisions experience risk differently, and when stress intensifies, these differences become harder to reconcile. A leak often reflects the perspective of a segment of the institution that is closer to emerging vulnerabilities and less willing to accept the comfort of official reassurance. Perhaps the most revealing hook is this: leaks tend to precede formal acknowledgement. By the time institutions publicly revise their outlook, the internal debate has already been resolved in favor of caution. The leak is an intermediate stage in this process, marking the transition from denial to adjustment. It signals that uncertainty has reached a level where informal communication becomes necessary to manage expectations. In economic terms, insider leaks are not random events, but indicators of structural strain within decision-making frameworks. They expose the gap between public confidence and private concern, and they often appear at moments when institutional belief systems are being quietly rewritten under the pressure of unfolding realities. Financial markets periodically reach moments where abstract valuation models collide with physical and economic limits. For extended periods, liquidity, credit expansion, and policy intervention can suppress these constraints, allowing prices to reflect expectations rather than material conditions. But when supply-side pressures intensify and debt saturation deepens, markets are forced to reconnect with realities that cannot be deferred. This re-anchoring process is subtle at first, visible only to institutions monitoring the real economy beneath financial instruments. Here is the first hook. Monetary policy can influence prices, but it cannot manufacture resources. When production capacity tightens, energy costs rise, or critical inputs become scarce, financial assets tied to those inputs begin to behave differently. Institutions recognize that policy tools lose effectiveness in the face of physical shortages. At that point, risk models stop prioritizing interest, rate projections, and start emphasizing availability, logistics, and replacement cost. This shift reflects a broader reassessment of what constitutes economic stability. For years, markets operated under the assumption that demand could always be stimulated and disruptions smoothed through intervention. However, repeated supply shocks expose the limits of that approach. Inflation driven by scarcity behaves differently from inflation driven by excess demand, and it resists traditional containment methods. Institutions adjust positioning accordingly, not to predict prices precisely, but to protect against persistent structural pressure. Another critical hook emerges in the relationship between purchasing power and market confidence. As real incomes stagnate or decline, consumption patterns weaken even when nominal indicators appear strong. This divergence undermines growth assumptions embedded in asset valuations. Financial institutions tracking these dynamics understand that weakening demand constrained by affordability cannot be resolved through credit expansion alone. The result is a cautious repositioning away from narratives of perpetual resilience. Re-anchoring also exposes the fragility of financial abstractions built on expectations of seamless global integration. Supply chains optimized for efficiency rather than redundancy struggle under geopolitical tension and resource competition. Markets begin to price fragmentation, longer lead times, and higher baseline costs. Institutions that recognize this early adjust exposure toward assets and strategies that benefit from structural tightness rather than cyclical recovery. Perhaps the most revealing hook is this: when markets reconnect with real economy constraints, volatility becomes structural rather than episodic. Price swings are no longer reactions to news but expressions of unresolved imbalance. Financial actors adapt by favoring positions that can withstand disorder instead of relying on smooth normalization. This behavior signals an acceptance that the economic environment has fundamentally changed, even if public discourse continues to frame disruptions as temporary. In this context, institutional repositioning is not a judgment about short-term market direction. It is an acknowledgement that the underlying economic foundation has shifted, and that future outcomes will be governed less by policy promises and more by the inescapable limits of production, labor, and resources. Modern financial markets are defined not by dispersion of power, but by its concentration. A small number of institutions command outsized balance sheets, privileged access to liquidity, and deep integration with policy mechanisms. In such an environment, individual decisions by dominant players do not remain isolated. They propagate through the system, reshaping incentives and constraining the choices available to others. Market direction becomes less about independent judgment and more about adaptive alignment. Here is the first hook: when power concentrates, choice disappears. Smaller institutions and market participants may hold different views, but they cannot afford to act on them if doing so means absorbing volatility generated by larger actors. Once a dominant institution adjusts its positioning, counterparties must reassess their own exposure, not based on belief, but based on survivability. This creates a gravitational effect where capital flows cluster, amplifying the initial move. This dynamic accelerates market shifts in ways that appear sudden but are structurally predictable. Concentrated systems transmit signals rapidly through funding markets, collateral chains, and derivatives exposure. A change in one major balance sheet alters liquidity conditions for many others. As these secondary institutions respond, the original shift gains momentum, transforming a strategic adjustment into a macro-level event. Another critical hook lies in the illusion of consensus. What appears as collective agreement among institutions is often enforced conformity. Risk managers align not because they share identical outlooks, but because divergence becomes too costly. Volatility penalties, margin requirements, and counterparty risk force alignment. This suppresses dissenting strategies and narrows the range of market outcomes, increasing the severity of moves when they occur. Power concentration also weakens the stabilizing role traditionally attributed to diversification. When major institutions hold overlapping exposures, the system loses its shock absorbers. Stress is no longer distributed, it is synchronized. In such conditions, coordinated shifts are not the result of collusion, but of structural design. Institutions react to the same constraints, face the same funding pressures, and therefore move in the same direction. Perhaps the most revealing hook is this in concentrated systems. Leadership is expressed through action, not announcement. The first major mover effectively sets the terms for the rest of the market. Others follow not out of trust, but out of necessity. This dynamic converts private risk management into public market impact, blurring the line between internal decision-making and systemic consequence. In economic terms, systemic power concentration transforms markets from discovery mechanisms into transmission mechanisms. Prices reflect the flow of dominant balance sheets rather than the aggregation of independent information. When those balance sheets reposition, the system adjusts around them, reinforcing the move and embedding it into the macro landscape with a force that few participants can resist. So when you hear that J.P. Morgan has gone long, do not hear optimism, hear urgency. Do not hear opportunity, hear repositioning ahead of stress. The real lesson is not about one bank or one trade. It is about a system that repeatedly signals confidence while preparing for crisis. Those who understand this do not wait for official confirmation. They watch behavior, not headlines. And here is the final hook to leave with you. When the architects of the system quietly step to the other side of the trade, they are not predicting the future. They are reacting to a future that has already begun. The question is no longer whether change is coming, but who will understand it in time, and who will be left holding the story instead of the strategy.